Okay. All right. So another thing is to long-term investing. And so I just wrote this out because I want you to be able to reference it and that kind of thing. But the easiest way to minimize your tax burden is to make sure that you hold your investment, doesn't matter what it is, if it's a house, securities, crypto, it doesn't matter. If you wait 12 months or more to sell your crypto, security, or other assets, the American tax code is set up to encourage long-term investment. So the capital gains tax on profits of assets held more than 12 months will be significantly lower. So here is showing you the difference between capital gains versus capital losses. We're going to talk about that for a minute. And like I said before, nothing happens until you sell something. So when you sell something, that's considered a triggering event. So in order for you to have a capital gain on something, that means you made money in that transaction. You bought it for $10,000. That's your cost basis. That's what you paid for it. And then you sold it for $12,000. Well, you have a capital gain of $2,000. So you will pay the capital gain on just the $2,000. You don't owe it on the original $10,000 you put in. That's why it's so important for you to keep track of your purchases and your sales. And we'll talk about that a little later. But in order for there to be a capital loss, let's say you bought something for $10,000 again, but you sold it for $8,000. So you lost $2,000. That capital loss of $2,000 you can use to write off against any gains that you have, and even $3,000 of it can go towards your ordinary income. So you'd have a tax write-off by selling at a loss. Sometimes people do that just to harvest the losses. Other times people do it because they just need to get part of their capital back, part of their original investment back. They need the money or whatever. So people sell stuff for lots of different reasons, but this particular discussion is based on taxes. So here, I wanted to explain about the capital gain long-term versus short-term. So the long-term capital gain is if you held that investment for 12 months or longer. The maximum tax rate on a long-term gain is 20%. So if you're in the 10% tax bracket, let's say, you would only pay 10%. But if you're in the 38% tax bracket, you would max out at 20%. So on the short-term side, if you hold that investment for less than 12 months, your maximum tax rate can be 37%. It's almost double. So if you had an investment for 10 months and you knew that the difference between holding it for 2 more months could be almost twice as much in taxes, you may want to consider holding it so that you go past the 1 year.